Say it again. I had it on mute. I'm sorry. Okay, here she is, Sue.
Good afternoon, everyone. This is Christina Bennett. I'd like to call today's investment meeting to order on October 19th, 2023. Sue, can I get a roll call vote?
Angela Banks.
Here.
Christina Bennett.
Present.
Lewis Cross.
Present.
Okay. Sheila Goodwin's unable to attend. Shanice Johnson.
Present.
Donna Jones. Yvette Levy. Martell Mann. Bobby Richardson, she's unable to attend. Albert Sanders, is unable to attend. And Doris Walker.
Here.
Okay, good.
So do we have a quorum? We have 4?
We have 5, so we do have a quorum.
Great. Let's proceed with the meeting and have ANCO present their presentation today. Sue?
Okay. And I will put that up, assuming we'll start with the private equity discussion.
Yes.
I'll put that up.
Okay, so tonight we have Justin Elsesser and Elizabeth Wolf, who are both researchers within our private equity department or private investments department. And they put together a education on private equity, as well as a recommendation as part of the pacing study that we did. So I'm going to turn the floor over to Justin and Elizabeth. If there are any questions, please feel free to ask questions. And then at the end, we'll be looking for a vote to accept the recommendation on the investment fund that we will be showing at the end of the report. Any questions of me before I turn it over to Justin and Elizabeth? Okay.
Well, the only question I had is the rationale behind just one name versus 2 to 3, and they can explain that when they present.
Okay.
All right. Well, thank you, Walda. Can everybody hear me okay? Make sure I'm coming through loud and clear.
Yep, sure.
Yeah.
Can.
Great. So just an introduction to myself. It's great to talk to you this afternoon. I'm Justin Elsesser. I'm one of the leads on the research team, specifically in private markets. I oversee our private equity team and our hedge fund team based in Orlando, Florida, where we're headquartered. Elizabeth Wolf, who's on the call also, she's an analyst on the private equity team, and she has coverage in areas that include co-investment, which is one of the areas we're presenting today. Like Walda said, during my presentation, we're going to start off with education, about 30 minutes, walk through kind of private equity, how we look at the space, how we split up the space, and how we kind of approach it when we're choosing managers. Please feel free to stop me at any point. Happy to answer questions as we go. Also, I'll leave time at the end for anything that comes up. We can start off on slide 3, and I'll address the one manager question if you want when we get to the single manager, or I can address it at the front if you prefer.
Anybody have a preference? Sue? Christina, got a preference?
No preference.
No preference.
We can do education because that really helps to do before presentation.
Absolutely, yes. We can start off on slide 3. We're going to start off broad and then kind of slowly get more specific, kind of ending with the definition of co-investment. So broadly speaking, the definition of private equity is broadly defined as investments in companies through negotiated transactions that typically result in private ownership of a business. That's about as broad as we can get in how we describe it. Typically, when we kind of go through education, it's helpful to kind of draw parallels or differences with other more common asset classes. And the normal one that we draw parallels to is public equities, right? So we kind of break down the differences between investing in public equities and your public stocks that is pretty common across all institutions versus what we do in the private space. And really, those differences boil down to 3 areas. And that's what they invest in, what private equity invests in versus public equities, how they create value between those 2 different strategies, and then the vehicles in which you invest in order to gain access to those 2 different strategies. So kind of starting off with what they invest in. If you think of your public equity managers, your stocks, those are public companies that any of us can go out and buy today if we wanted to through a broker. They're defined lists. They're listed on stock exchanges. We can go and get a list of every stock trading on any stock exchange on Yahoo Finance or any common website. And they regularly, quarterly put out public financial statements and public quarterly meetings, and they have different requirements, et cetera. So that's the public equity side. On the private side, the difference there is that the sourcing and the universe in which these companies invest in is much more idiosyncratic, right? So there is no list of private companies anywhere where you can just go and look and see what's available, what's for sale, what the price is. There's no way you can go out and get financial information about any of these companies unless they give it to you directly, because there's just not a database out there. There's databases that people try to put together, but they are very incomplete and generally are based on picking up a phone and calling different businesses to try to put things into a database. Because of that, the sourcing dynamic in private markets is incredibly important. These companies have to go out, they have to create relationships with business owners, they have to create relationships with investment banks, who are typically the individuals that broker these types of transactions, and they need to really spend time and energy to go out and understand what companies are out there that they can target in order to acquire or to create their value, and so that they can fulfill their strategy within their fund. Because of that also, it means that in the public equity space, where you might look across 2 or 3 different managers and you're going to see overlap, you're going to see 3 or 4 managers all own Amazon to different levels and different time periods and at different prices, but they'll all own it. And it's the same company based on the same information. They might have different theories about what it's going to do, but they'll have it. In private equity, that's not generally the case. Once you go out and buy a company, if a buyout manager buys that company, they own it. You're not going to see it in another portfolio. So because of that, it's very specific. When we look at a fund, you're not going to see a ton of overlap between other investment individuals and the companies that they have in there. You're not going to have public information on it. That goes into value creation. So how is it different how private equity drives value versus a public equity? Public equity managers, they decide to buy a stock, they decide to hold a stock they already own, or they decide to sell it. Those are the 3 decisions they have, and they make those decisions based on the same public information that we all should have, plus their understanding and their analysis of that information, which should add value. But if they go in and buy a stock and they say, okay, we think this stock is going to do this because management says that they're going to create a new product and they're going to do this, that, or the other thing. And then it turns out management decides not to do that. Well, then they can sell and say, okay, that didn't work out. You know, they went in a direction we don't agree with. We're going to sell. In private equity, these buyout managers have what I like to call kind of ultra accountability, because they're buying the company, they hire the management, they set the strategy. They are not only identifying the company as something that is attractive to own, they're the ones driving everything. And that's for good or for bad. If things go bad, you can't say, well, management did something we don't agree with. Well, you hired management and you can change management if you so choose. On the flip side of that, if things work out really well, they drove that value. If they found a company that was performing really well, they put the right team in place, they invested the capital right, the strategy was sound, and then the company doubled or tripled in value. Well, then they got the full benefit of that, and then their fund should generate the types of returns we're looking for. So the level of accountability and the level of responsibility they have in the performance of these businesses is much, much higher because of the fact that they fully own them. And then the last is the vehicles that you can gain access to these strategies, right? With the public equities, the most common one is mutual funds. You can buy into a public equity strategy. The capital goes in when you buy. Almost the next day, the manager will have it and they can put it into the publicly traded stocks almost seamlessly, as long as it's a liquid market. Same when you get out and you can decide on Monday, oh, we don't want to be in this anymore. We're going to put it to sell. The next day, you should have your capital out based on the closing value of that mutual fund share. Private markets, it's not that way. These are very illiquid vehicles, and they are closed-end structures, which basically means they have fund lives of between 10 to 12 years, generally in private equity. And once you commit to the fund, you can't get out unless you do some type of secondary sale in the market, in a secondary market, which can come at a big discount. So that's the illiquid aspect of the asset class. And these 10 or 12-year funds, when you commit, your capital isn't invested in all immediately day one. It's called and slowly invested over 3, 4, or 5 years. So the first 3 to 5 years of a fund is the investment period. That's where they're going out and putting the money into these types of companies and private transactions. And then after those first 3 to 5 years, they should have a fully built out fund in which they can generate and create value. And then they're going to go out and sell these companies. And as they sell them, they then return that money and that value back to their investors. So whereas mutual funds, you put in the money, you decide when to go in, it's there almost immediately. And when you decide to sell, it comes out almost immediately. Over the course of 10 to 12 years in these private funds, you're going to have money go in slowly, create value, and then come back to you slowly. And that creates a dynamic where you have to consistently commit in order to maintain exposure to these spaces. And it creates different types of performance measures we use to evaluate them, and a different way to looking at it, especially in the early days when a fund is investing. Because in the early days, it's not fully invested. We are really paying attention more to the companies they're buying than the performance itself, because it takes a while for that value to be created. So if we go on to the next slide, slide 4, we're going to go a little, that's broadly private equity and the differences, especially relative to the public equity space. This goes another layer deeper into private equity. So just like in any other asset class, whether it be real estate, fixed income, or public equities, there are different styles and different types of investments that can be done within this broad umbrella that we call private equity. Much like publics, you have growth, value, large cap, SMID, or small cap stocks that you can buy. In privates, the main styles are venture capital, growth equity, and buyouts. And these styles are defined basically by the life cycle of the companies within them. So you can look at that chart down at the bottom where the life cycle of a business, starting with venture capital, and I like to draw parallels. I like to give real world examples to kind of drive home what this means. Venture capital is everything from I just have an idea of something I think is going to be good, all the way up to, okay, I've built out that idea in a limited fashion, but now I need more money to kind of take it to the next level. I use a parallel for restaurants. If I have an idea for a restaurant or a food truck that I think is going to be a good idea, that's a venture investment. I don't have it yet. I haven't built it. I haven't even tried it, but I have an idea. So I'm going to go out and try to get capital to try to make that happen. And then that's all the way up to maybe I have the food truck, the single food truck, or a single location. It's producing, I'm earning money, it's performing well, but it's not a full-fledged business. It's still a very small fledgling enterprise. That's kind of a venture capital investment, right? So that's early stages into a business's life. When you get into the growth equity or the expansion stage, at that point, I have a proven product or something that has some type of proof to it, and I think I can scale this. So now I'm taking it from that one food truck or that one location restaurant to I want to be a regional player. I want to open up 10 more locations. I want to go to a few different cities. I want to expand into the general Southeast or the Northeast or the Midwest. And at that point, I'm trying to take my business to investors and say, here's my proof of concept. I don't have the money to do this myself, but I would like to raise capital from you, get capital injected into my business, and then kind of have you help me build that out. And typically, whenever you're doing these types of investments, both in venture and growth, you're not selling your full company, right? These two are different than what we're about to talk about in buyout. In venture and growth, you're selling a minority position. So you're selling 10, 20, 30% of your business. And then these groups will help you kind of operationally build out your actually true company. So sticking with the restaurant example, if you want to take it from one location to 10, and maybe as a founder and entrepreneur, you're a great chef, you know food, but you might not know real estate. You might not know supply chain. You might not know HR technology. So if you're going to hire the managers, the waiters, the cooks, if you're going to have to go out and find locations to build your restaurants at, maybe these groups will have a real estate expert that will help you negotiate those contracts. They'll have somebody who's an expert in setting up supply chains to get you a reliable supply of food and produce and ingredients. They'll have somebody who's an expert in HR management and how to manage those systems and do payroll and all things like that. They're going to help you with those blocking and tackling kind of back office boring aspects a lot of people think of a business, but are critical to success. Without those things, you cannot have a successful business. So a lot of times they will add that value to the business as well, and they'll bring that expertise and help the founder and individual kind of build that out in a more institutional and professional way. And then we get to buyout. which is their mature stage. So the graph is a little deceptive in that it looks like venture capital is bigger than growth and buyout. Buyout is the biggest in terms of assets of these three types of investing. If you hear somebody talk about private equity, more than likely they're talking about a buyout transaction. The second would be venture capital. Those are the two most common. Growth equity in the middle is about a half to even a third of those two groups, depending on how you look at the assets. But a buyout transaction, these are fully built out scaled businesses, right? This is Olive Garden or Texas Roadhouse. This is a business that has management, that has proven concepts, that has cash flow, that is profitable. This is a business that generally in a buyout transaction is going to have control transferred to the private equity group. So in this instance, they will buy controlling interest in the company because they have identified some type of improvement, some type of strategy that they can do that will increase the value of that business from where it stands today, from where they're buying it. That's the key difference between a buyout, a growth, and a venture capital transaction. It's really about the stages of where the company is and the needs of that business at those different points. And because of that, when we're evaluating these strategies, there's different levers and value creation levers you can pull depending on where a company falls in this life cycle. And people have different specialties when it comes to pulling those various levers. We spend a lot of time making sure that we pick groups that have that and can consistently do that over time. So on the next slide, slide 5, I'm going to spend a little bit of time on slide 5. This goes into what we talked about with vehicles and how they're different for private markets versus publics. This is kind of shows the J-curve visualization. I mentioned that capital gets called over time during the investment period, the first 3 to 5 years. It's invested and then value is created and then it's sent back. This is kind of a visual representation of that. If you look at the blue and red lines, capital gets called early. You're going to have a little bit of a dip. It's called a J-curve. That's a normal kind of function of these private funds. And then as the fund is fully built out and the value is created, it should surpass the original value of the capital that was sent in. And then the capital is realized and sent back to you in forms of cash distributions. So this is just a visualization of kind of that dynamic. On slide 6, we'll get into a little bit of some of the things we look at when we're evaluating these private managers. We do this on the public side as well. A lot of this is overlap, but because there's differences, some things matter more or are harder to get a handle on in the private space than it is in the publics. Team is a big one, right? We mentioned team stability here. When we commit to a private fund, generally there are either very few investments or even no investments in that fund. We're committing to a team. We're committing to a team that has a track record, that has executed a strategy previously, right? So we spend a lot of time to understand who's responsible for that track record in the team. We understand compensation dynamics, ownership, who's reporting to who, how long have people been there, what are their backgrounds, et cetera. We spend a lot of time understanding the team because it is critical when you're committing to a fund like this, because that is what's going to drive the investment of the fund and the value creation and the exiting. We mentioned about active management and how they are accountable. So the ability to add value through active management. We don't want somebody that's just going to buy a company and then just let the cash go. You need to have an angle when you're buying a company. You need to have some kind of value proposition. The fees we pay in this space are bigger than what we pay in publics. Therefore, we expect a bigger result. If you're not producing a result to justify the fees, then we would not want to commit to you. That at some point you have to be able to produce that value. We mentioned about the difference in sourcing, how there's no kind of public list for private transactions. This goes into the sourcing deal flow. We spend a lot of time making sure they have those relationships, make sure they're seeing the deals that they need to see in order to fully invest these funds and invest them in attractive businesses for the long term. And then balance sheet and valuation policy. For a balance sheet specifically, there's a lot of talk about leverage and debt in the private equity space and private markets in general. We do spend a lot of time understanding how our managers use debt in these businesses. If they're using too much, if they're kind of pushing it to the maximum edge, over time, do they pay down debt or do they use it to do additional acquisitions? We make sure we understand that because it is a risk. And if you look historically at private equity, one of the most common ways that private equity underperforms is if a manager puts too much leverage on a company, and then we have a fall in macroeconomic circumstances or a recession. If the company can't survive that and it goes bankrupt, that's the most common way that private equity underperforms. If in those scenarios, the manager is more temperate and then the company can survive, generally they actually outperform on the other side of those periods versus their peers. So it's just about making sure that we're not pushing the envelope on leverage, that they're not using it as their primary driver of value. It's a tool, but it's a tool that needs to be used thoughtfully and in a semi-conservative, responsible manner. If you look at the next slide, slide 7, just a few more items we look at. Exit strategy. So it's not enough to buy a good company. It's not even enough to add the value to the company. You need to be able to then realize that value, right? We need to see that you are sending capital back to your investors who are our clients. They need to be getting that cash back so that they can use that cash for whatever they need. If it's to redistribute in their portfolio, if it's to pay beneficiaries, whatever it might be. This is a big topic in the market right now because of deal flow and having fallen off in the last year or so. Is we need to be able to see that managers have the ability to exit the positions that they have. Spend a lot of time on that. Track record really encompasses sourcing, value creation, exit strategies, team. It encompasses kind of everything. When you think about what our track record analysis is, it's all of those components together. And then when you have terms, a lot of people think just fees whenever we talk about terms, but it's also governance, right? So we do look at fees. Are your fees relative market fees relative to other managers of your type? Are you producing the level of returns that would justify these fees? But also governance. We mentioned these are illiquid vehicles, 10, 12 years. We look at provisions, key person provisions, manager fault provisions, no fault manager divorce provisions, liability provisions in there, because those provisions are important when it comes to protecting investors in these funds. Even though they're illiquid, there can be provisions that if a manager is a bad actor, or if they don't do the right thing, or if they're not following a strategy, that the investors can use to either take control of the fund from the manager or at least hold them accountable in a way that can force them to kind of change their behavior or change their direction. So we spend a lot of time on those governance issues to try to make sure that we have as much protection as we can for our clients and investors in those strategies. On the next slide, slide 8. So we've talked about private equity generally, and then the styles of private equity. Now we want to get into how you can access them, right? So there's different ways and different methods you can get access to the private market space or private equity and private market space generally. These are the 4 most common. I'm going to go through them, and you have exposure to some of these already. And I'm actually going to go out of order. I'm going to start with the ones you have exposure to. So if you see fund of funds, you do have several positions in fund of funds within your portfolio. A fund of fund is just a manager whose job it is to go out and invest their fund into other private equity funds. Why you use that? You use that because it allows you with one commitment to get a broad diversified exposure to the space. It's an efficient way to do it. If you have less capital commit, or if you prefer not to have the operational risk or burden of having to kind of facilitate all these private investments, it's a way with one commitment to gain a broad exposure. And you would hope that that fund of fund manager is choosing attractive managers and outperforming managers, which then should lead them to outperform. A secondary fund is roughly the same thing in that fund is going to invest in other private equity funds, but they do it in a different fashion. Instead of committing to those private equity funds at the start, what they'll do is they'll identify funds they want exposure to. And then when other investors say they want to sell out of their private equity holdings, let's say if I have a $10 million allocation to a private equity fund that you would want exposure to, maybe I need liquidity for some reason. Maybe my portfolio got out of balance or whatever the case might be. I might want to sell $5 million worth of my private equity fund. A secondary player would come in and say, okay, we'll buy that off you, but it's an illiquid market, illiquid transaction. They wouldn't pay me $5 million. They would pay me $4.5 million or maybe $4 million. So they're buying it at a discount. And then they get their full value of my piece. And in turn of that, I get to realize or create liquidity for myself in an otherwise illiquid market, right? So that's kind of a secondary transaction. Now, both of those fund of funds and secondary funds invest in direct funds, which is the second from the top. A direct fund, simply put, is just one private equity fund, whether it be buyout, growth, or venture capital. It's just one manager with one strategy and one private equity fund. So fund of funds and secondary funds are made up of direct funds. The caveat to the fund of funds and secondary funds is that there are two layers of fees there. Because you're paying the fees to the direct fund manager, you're also paying the fees to the secondary fund manager and the fund of fund manager. So that can eat into the alpha that those strategies can produce. The co-investment funds at the very top is what we're going to present today. So a co-investment fund is where you have a co-investment fund manager, similar to a fund of fund or secondary fund manager. You have that manager at the fund level, and their job is to go out and find direct fund managers that need capital for specific deals. And what they'll do is they'll invest capital from their co-investment fund alongside that direct fund manager. Maybe the manager just ran out of money in their fund. Maybe they are buying a transaction that's a little too big for the capital they have available, or a little too big for maybe how they want their portfolio to be balanced out. There's a bunch of reasons why this can take place, but that's their job, is to go out and invest alongside those direct fund managers. And the caveat there is that those co-investments are generally almost always done with no fee, no carry. Sometimes there are very few instances, but the vast majority, you're not paying management fees, you're not paying carry. So with the co-investment funds, you only have the one layer of fees instead of the two that you get with fund of funds and secondaries. And that one layer of fee is generally roughly half of what we're paying in direct funds, if you look at the comparable funds at management fee and carry level. So those are the different ways we can access the space. They all have positive and negatives, and we're going to get into some of those here in the coming slides. If you go to the slide 9, this lays out some details about each of these different vehicles. It lays out general fee terms, time periods, minimums, etc. Really, I want to highlight two different lines, and that would be the investment diversifications, which is third from the top, and then fees on underlying holdings, which is the very last one. So the investment diversification, this is where some of the risk comes into play. So when you have a direct private equity fund, which is that first column, that fund is going to have anywhere from 8 to maybe 15 holdings in it. You know, some have a little more if they're bigger funds, but that's generally what you're looking at. That's a very concentrated number of holdings in one manager that is going to have one strategy. Maybe it's a healthcare focused manager, maybe it's consumer focused, maybe it's about building out, doing a lot of add-ons and doing a lot of mergers and acquisitions to kind of add on to the companies that they do. It can be various strategies, but you're having that one fund, right, in 8 to 15 positions. If you look at fund of funds and secondaries on the diversification scale, with fund of funds, you're committing to 15 to 25 underlying funds. If you look at each of those having 8 to 15 companies, you're going to get into having a fund of funds that, if you go all the way down to the individual company level, is going to have hundreds of private companies to be a part of it. With secondary funds, it can even be more. It can even get up to the thousands of private companies. So those are ultra diversified, right? They're very diversified, broad swath of the market, et cetera. Multi-manager co-investment funds, you're generally going to have 20 to 60 holdings, right? So you're going to have more than what you have in a direct fund. You're going to have far less than what you do in fund of funds and secondaries. That concentration, they're still generally built out to be diversified by sector, and they're going to have their geographic kind of tilts to them. But the diversification you get there reduces that risk a little bit, because it's not only just sector diversification, but they're doing these deals alongside different general partners. So you're not focused on that one general partner that maybe just does healthcare in that direct fund, and that's all they do. Your co-investment fund will do a deal alongside a healthcare manager, and then a deal alongside a consumer manager, and a deal alongside an industrials manager. They'll spread it out and diversify by strategy and general partner and sector and all that, which reduces the overall risk of the fund, because you're going to have a broader level of exposure across different sectors and end markets and et cetera. So that helps with the risk factor. On the fees on the underlying, that just represents what we discussed on the last slide, which is that direct private equity investments and multi-manager co-investment funds just have one layer of fees, versus the fund of fund and secondary fund managers, where you're going to have 2 layers of fees. So that's an important difference between these kind of 4 different vehicles. On slide 10, we're going to dive a little deeper into co-investment, and I want to kind of put real examples around kind of what this is and kind of how this works. As an example for a co-investment manager, let's say I am a buyout fund manager. I have a buyout fund and I focus on industrials, and I find a plumbing business that I love and that I really wanted to invest in. Okay, it's going to cost me $500 million to invest in it. Let's say in my fund, with how much money I have and how I allocate across deals, I can only invest up to 450 million in a single deal. So I have a $50 million gap. So what I'll generally do is I'll call up people first that invest into my fund, right? I'll call my different LPs and I'll say, hey, we have a great deal. We need 50 million in order to execute it outside of the fund. Would you be interested in that? And then eventually, if they find somebody, a co-investor, they'll say, yes, I am interested in that. I can give you 50 million. At that point, that person is a co-investor and they'll get that no fee, no carry. They're not paying fees on it. There no management fees, no carry outside of that. And now you have exposure to that deal. Now, the general partner that found it and bought it, they're running the deal, right? They have control. They get to hire management. They get to execute their plan, all that stuff. You are just along for the ride as a co-investor. But if you know the general partner and you've looked at the company and they've given you information on the company and you buy into their plan and vision for the company, you could feel good about it. Also with the fact that you're not paying fees on it. You do that, and then you do that multiple times across all these different relationships as a co-investor you have, and you build a portfolio that is diversified. And what we look for in our co-investment managers, the value we look for them to add is in the sourcing, is having those relationships so they get access to that deal flow. And also in what we call deal selection alpha, right? So if you're a co-investment fund manager, and let's say you're going to have 40 deals in your fund, and you want 4 of those 40 deals to be healthcare deals. What we want you to do is to be able to see 20, 30, 40 healthcare transactions from different private equity groups and choose the best 4. It's almost like you're getting a second look at deal flow. It's almost like you're getting to draft after everybody did the NFL draft. You get to see who everybody picked, and then you get to draft off of the results of that. We would expect our co-investment managers to be able to look at these transactions, which all these general partners like, and be able to choose the ones that have the best chance at outperformance. That's the value proposition of what they provide. That's what we're paying them fees in order to facilitate. But that's kind of a look through into what a multi-manager co-investment fund does, how they do those transactions, and what we would expect from them in order to earn their fee. We go to slide 11. This is just a visual representation on a risk to return scale, with the top being the most concentrated but highest return potential, and the bottom being the most diversified and the lower return potential of where co-investments fall. The top is that direct private equity fund, which we've talked about. So a buyout fund, for example, a single buyout fund. The bottom is your fund of funds, such as groups that you have already committed to, where you're having multiple different direct private equity funds, and each one in there has its own companies. In between these two sits that multi-manager co-investment fund. So it's kind of in between there in a diversification spectrum. We would also expect it to be in there in kind of the same range between those two in the return spectrum. And we like to pair these types of vehicles with our fund of funds holdings for our clients because of that fee dynamic, right? We try to get fees down wherever we can, and having that core of fund of funds provide you the core holdings in the private equity space, but then pairing it with maybe an outside allocation of 20 to 30% of the portfolio in co-investments helps us to kind of reduce the overall fees being paid in the portfolio, which is what we're trying to do. Because if we pay less fees, but we still do good deals, then the returns should be there even more so than if we're paying kind of higher than market fees or even double their fees. So that kind of concludes the education portion. I want to pause there. I know that's a lot of information. We took it from broad base down to kind of specific co-invest. I'm happy to answer any questions anybody has on any of that, or on topics unrelated to that as well.
No questions on the education part before he delves into the actual recommendation? Guess not.
Okay. So I'll address the one manager question. If we could skip ahead to slide 14. So we have different clients that prefer different ways of doing this. Generally speaking, whenever we present managers, we can try to give options if that's something that's desired, but generally there is like a best fit for a portfolio. So we do spend time, we look at clients' portfolio ahead of time. We'll look through their current holdings, where things lie as far as geographic allocation, sector allocation, et cetera. And we'll look at that relative to our current list of approved managers. And we'll say, this is probably the group that we should go with. This is definitely the best fit. That's what we did here. Now I'll defer to any conversations moving forward. And, obviously, Guelda, her and I work together on many clients, if it's preferred to bring another option as well, I think we're open to it. We have different ways we can do this, but we just felt that, we always want to present the option that we think best complements your portfolio and gives you the chance to outperform. But that's kind of why we did it this way. This was our first recommendation to you. So we just decided to move forward with that option. But in the future, and obviously happy to accommodate whatever you would like us to do moving forward. I hope does that help with that question? So,
Christina, did that answer your question? I don't know if you can hear me.
Feel free to follow up. Happy to, or just interrupt me as we go through too, if somebody's muted and can't speak up at the moment. But one more slide forward on slide 14, I can start on the current manager. So we brought Neuberger Berman. Neuberger Berman's Strategic Co-Investment Partners 5 is the fund we're proposing for today. We can go to the next slide actually, where there's more information on the manager themselves. So Neuberger Berman is a large asset manager, roughly $80 billion in assets under management. It is 100% employee owned. It's owned by the professionals that actually invest the funds, which is alignment that we like to see. They have a very large private equity team at 55 people. These 55 people will analyze not just co-investments, but also secondary and fund investments as well. But out of those 55, there's 19 kind of deal captains that really lead the co-investment side of things. And it's important to have a manager of this scale and size as well, because you want them to have those relationships and the professionals to cover a wide swath. Don't forget the deal dynamics, the number of deals they see, and their ability to analyze those deals is key. In order to have those things, you generally need a decent amount of assets under management and a decent number of funds that you're committing to in order to generate that deal flow. If you look at some of the dynamics of the strategy, it's going to be 70 to 75% North America, 20 to 30% Europe. The position count is going to be 30 to 40 deals. The strategy breakdown, you can see there, is 90% buyout. So 90% of those mature businesses we talked about where they're taking control positions, and 10% or less growth. So just one step over, they won't do venture capital. So they're not going to get into the early stuff, which is more high risk, high reward. So they're staying away from that, which is what we would prefer in a strategy like this. That they stay away from that, to be clear. We're going to get into, we list here the deal structures, co-underwrite, midlife, and syndication. I'm going to get into that in 2 slides because it's a differentiator for the strategy. But just know that they do different types of co-investment deals, and I'll explain what those are and why that's important here in a couple slides. And then the bottom, second from the bottom, you'll see the annual deal flow. They see over 500 deals a year, and they close on far less than 10% of them, right? So they are seeing the transactions that we feel like you need to see in order to choose those really high quality deals and build out that kind of diversified value creating portfolio. On the next slide, we can.
Justin, I just wanted to ask real quick, and they are for this fund domiciled domestically?
Yes, yeah, they do have a domestic feeder. We checked into that. Well, we understand there's a need for that with how your fund is set up, and we did confirm we should be okay with that on that side of things.
Okay, thank you.
Absolutely.
And I'm sorry, this is Christina. I had to take a work call and missed a little bit of your presentation for about 4 minutes. So on this, can you tell me what other firms you looked at? And usually and typically, and I'm speaking for the board, we've never had a recommendation come with just one name. We've always had 2 to 3. We've always made sure that there was if there was a diverse manager or an emerging manager that was in this space, that they introduce that as well, so that we can take a look and make a selection. And I apologize again if I missed this But I wanted to touch base as to why the recommendation was only one name.
Hi, Christina. Can you hear me? This is Jeff.
Yes.
Yeah, so let me jump in on this really quick. So just, and I know Justin did go over it a little bit before, but I think it's kind of important just to understand, I think from the standpoint of the life cycle and the capital raising cycle of these funds, doesn't always have the stars and the moon aligning that we can come to the table with multiple selections. And one of the things that Justin did talk about, and we take a significant look at, it's number one with our pacing study and knowing how much has to get put to work at certain periods of time to sort of keep on target with our policy, the life cycle of what's out there, who's raising capital. And then, and I think even more importantly is just how everything gels with the current investments in the portfolio. So right now and I think Justin had mentioned this before, just with this certain sub-strategy, which is a good fit and an offset to a lot of the other pieces in the portfolio, that this is really kind of the only thing that was out there that sort of fits that bill. There's a lot of, and Justin can jump in with color, but there's probably a bunch of other firms that might be raising capital in certain areas where the system already has exposure. So I think it really just comes down to timing, and it's challenging relative to, like, if we were bringing in a large cap growth search that we could easily show you 4 or 5 managers, and they're probably all kind of doing the same thing anyways, but you at least have those choices. But I think just with capital raising cycles, how we need to pace, and really how we offset and complement what's currently in the system's portfolio, it kind of limits us. And I think just also just it helps us target and just bring to you what we think is the best fit for the portfolio.
And Christine, I will say there were some funds, some managers that came to me directly that had spoken with you or other members on the board or on the committee. And I was able to let them know, we did look at you. Some of them were fund of funds, which was not what we were going to recommend in the portfolio, because you already have a lot of those. We're trying to diversify the types of investment vehicles you have. In addition to that, we did look at a fund. I believe someone spoke with you from Mesirow co-investment, and we vetted that strategy at the beginning of the year, and Justin give more color on that. But there were some things that we weren't comfortable with, and it wasn't the best fit. So we did look at several different managers, and we look like, as Jeff said, and as Justin said previously, we're trying to get the best fit to round out your private equity portfolio.
Yeah, I'll add some color there. So, and Christina, to address some of what you asked directly. So we actually, when we go out and we source managers like this, we split up the area to the different types. And for co-investments, when we went out this year and started looking at what managers we wanted to bring in front of clients, we identified roughly 60 strategies that would fit into this kind of bucket of private equity. And we've talked to all of them. And whenever we started sourcing early this year, Elizabeth and I, we sat down and we started with a list of over 40 managers. And we looked at them, we looked at the dynamics, we looked at when they were going to be in markets. Jeff's point, not everybody's in market at the same time. And we just kept going down the line. And then we gradually got down to kind of the smaller subset of managers that we wanted to recommend. Mesirow being one. We actually talked to them a lot. And we do like certain aspects of that strategy, but there were some things that concerned us, and it was kind of more of we didn't want to proceed with them ever, but more of you're going through a little bit of a transition right now. We're going to wait till maybe the next fund and see how some of these things shake out, right? So there's sometimes those dynamics. You asked about minority or women-owned managers. We do pay very much attention to that. Unfortunately, in this specific space, because a lot of it is asset managers or larger asset managers, there's less of that. We only identified one manager that would fit into that category. We did talk to them. We've known them for multiple years, and there's certain dynamics. They're a smaller manager, and they didn't really have the primary and the fund investment side that can drive the deal flow that would allow for a strategy like this. We felt to fully execute on some of the things they wanted to do. We're still discussing with them, and we still hope that someday they can kind of get there. But I don't want to give the impression we didn't talk. We talk to almost everybody that does this type of strategy, and it's continuous. We do this every year. funds close, new ones come to market. So we're always keeping up to date with people in the space. As far as why we brought ones, Jeff's point, it is a little bit of fundraising dynamics, but we spend a lot of time looking at client portfolios. Whenever Gwelda said that, it came to me and said that we were looking to do that this year, I looked at your holdings, I looked at the allocation between fund of funds versus secondary managers. I saw you didn't have a co-investment component to it. And it's something we strongly feel, especially with the attractive fee nature of this, where this is kind of the lowest fees that you can get access to private equity. We wanted to make sure that you had exposure to co-investments. So that's why we kind of narrowed it down to, okay, we should present a co-investment manager. And then from there, from that smaller subset of managers that we fully due diligenced early in the year that we bring to our clients, we looked at the dynamics of, geographic allocation, sector allocation, risk return dynamics. We felt that this Neuberger Berman manager was the best fit for your portfolio. So we kind of went from style down to individual manager relative to what you already have. We do have other managers that we've talked to, other managers that we recommend. And like I said, I think it sounds like you missed it a little bit, but working together, I work with Gwelda and Jeff on many other clients. If that is something we want to make sure we do, which is bring two managers or whatnot, then we're happy to do what we can. We have many relationships that we kind of maintain, but sometimes with clients they like to just see, hey, just give me the manager that's the best fit for our portfolio. So since this was our first recommendation, that's kind of the direction we went. But happy to have further conversations about how you would like to do that moving forward. If I didn't answer any of your questions, also happy to do so again, or happy to do so. But does that help?
It does help. It does help. And I know that one of the big things that we have been accustomed to is where we receive 3 to 4 managers, and then we get to the outline, we get the recommendation, but we put the decision in the hands of the trustees based on the information that's presented. And sometimes we have made recommendations. We have hired managers that were presented, but maybe not the consultant's preferred recommendation. And so, again, this is the first time, but we can talk at another investment meeting with Gwelda and Jeff on how we see that going forward. I personally am not comfortable with one recommendation. Maybe for this strategy, if you're saying this is the only person in the market that's going out at this time when we need it and to fill our allocation, then I'm okay with it. But in the universe of investments, I think that's more of a dialogue prior to making a recommendation. So if it holds off the decision and the presentation by a month or two, I'm okay with it. But I think that you live and you learn, and these are the newlywed decisions, right? While we're still in this early stage. So I appreciate the detail and the education that came forward, because I think it helps a lot of the trustees.
Absolutely, and I'm happy to continue with this manager. And then at the end, if you decide to put off and you want to see other options, we can do that. Is that kind of how you'd want to proceed?
No, I'm gonna take the will of the committee, because again, I'm only one vote. But again, I'm not opposed to this manager, not opposed to this strategy. I just want to make sure that it is the right fit, and I like the structure of not of paying less fees. I don't think that that's an insight that Jeff and Gwelda bring to our platform that we weren't as accustomed to before. So I appreciate that aspect of it, because it is making our fund a little more stable, and less fees is always music to my ears. And we're getting, similar product and different exposure.
Absolutely. Okay. Well, I'll keep presenting with Neuberger Berman, and then at the end, happy to proceed with however the board likes to proceed. And that if it means coming back with other options, happy to do so also. We're here to facilitate whatever we need to. So on Neuberger Berman, the team is, I mentioned, is total of 55 private equity professionals, and there's 19 deal captains. It's led by the co-leads, David Morse and David Stoneberg. They've been at the firm for over 15 years, long tenured there. They have a lot of senior people that make up the other 17 deal captains. One of the things that we like most about this team is they have the experience. A lot of these individuals have investment banking backgrounds, actually worked at direct private equity shops. They have experience doing deals even before they came to Neuberger Berman. We think that's critical in a strategy like this. And the team is very stable. The firm is 100% employee owned. There's profit sharing. The fees are shared, et cetera. It has created an environment where there's very little turnover, especially on senior management of the investment strategy. And that's an attractive thing. We mentioned the team stability and making sure that the people that added value previously are still there. That's important. If we go to the next slide, just some key strengths and differentiators, and then points to consider. So we mentioned the team as one of the strengths. The other strengths is we mentioned that they invest in the 3 subtypes of co-investment. To put some more definition around that, going back to how I described co-investments at the start in that example, if you have that investor coming into that plumbing business at, for $50 million, they're coming in the first day, same price, same time as the general partner. There's another type of deal, and that would encompass both syndicated and co-underwrite types of transactions within co-investment. The difference between those two is simply that with syndicated transactions, typically the deal is pretty much already done, and the private equity investor has already negotiated the terms, and they're simply giving out pieces to the deal to some of their LPs. Whereas a co-underwrite, the person is doing due diligence and work alongside the general partner, so they get a little more insight, have a little more say in the direction that the due diligence goes. The third type of deal is really the differentiator for Neuberger Berman, and that's called a midlife transaction. So the difference here is that instead of coming in the first day that a private equity firm is buying a business, let's say that plumbing business, they're going to come in sometimes 1, 2, 3 years down the road whenever there's a need for capital. And maybe they're trying to do an M&A deal. Maybe they're realizing they need to invest in a new fleet of trucks and they don't want to take out debt to do it, so they want an equity injection. Maybe they're trying to get some liquidity for their investors out of that private equity fund. It can be a number of reasons, but they're coming in later on and they're providing capital to a general partner that needs it. And generally, they are able to negotiate attractive fees and there are attractive terms for the co-investment fund to put money into that deal. Now, there's a risk here because you're not coming in at the same time and often not at the same price. There can be a mismatch of incentives where, the private equity manager might already have a significant return on the investment and you're coming in at a higher price later. So they have to, and this is where their experience comes in, because their experience and their knowledge and their relationships in the marketplace allow them to identify those risks and mitigate them and come up with some very creative structures that have ended up having a big benefit and a big plus for their prior funds. And that type of deal in this market environment where there is a lack of capital, both from fundraising and also from debt providers, we think they're seeing a lot of very attractive transactions right now. So that type of deal we think is actually going to be a big benefit in this market environment specifically, even more so than others. Points to consider. The only thing we'll mention, we mentioned team. We keep an eye on team. The team is very stable and everybody is fully dedicated for this fund, but we like to see what's coming down the pike. And there is a chance that there might be some succession stuff in a fund or two. So we always cite that because we want to see it coming. We don't want anybody to be surprised, especially us. And the fund is larger. Neuberger Berman is a large asset manager, and that comes with those resources and capabilities, but it also means that they have to go into larger transactions. So that is something we keep an eye on because we do like the middle market area of the space. They're still able to add value. They still had attractive returns, but it's something we should note because it's, in all fairness, that's something that we take a look at. And then on slide 18, we could get into the fees. So you can see here, the carry is 10%. The market ranges from 10% to 15% in co-investments. Most strategies are between 10 to 12.5. So this is at the bottom end of the performance fee. That's what we like to see. And then the management fees at 1%, that's roughly half of what we would pay in a direct funds. So this goes back to, this is a very fee efficient way to gain access to private markets and to private equity specifically. And then if you look on the next 2 slides for the performance comparison, so it'd be slide 20. So the reason why Fund 1 isn't listed here, Fund 1 was actually invested, Neuberger Berman was owned by Lehman Brothers way back when, before the great financial crisis and global financial crisis. And then they spun themselves out, and now they're 100% employee owned. So the employees bought themselves out of Lehman. So Fund 1 was invested while they were part of Lehman. And really that fund wasn't a co-investment fund like we're committing to today. What that was a way for them to gain access and equity in some of the deals that the investment bank was doing at the time. So we don't show that because we don't think it's relevant to the strategy today. Funds 2 and 3 and 4 are very relevant. You can see Funds 3's performance is over 2.2 times with over 20% net IRR. That's our attractive performance numbers for that vintage class. Fund 4 is early days. It's only 3 years old. It's still being invested and finalizing its investments, but it is off to a really good start. It's already marked up 30% at 1.3 times net TVPI. So that's net of fees. Fund 2, you see the performance there doesn't look as attractive. It's important to note, and you can see there in the first footnote there, they did some energy transactions in Fund 2, and they very quickly realized that they are not specialized in that, and they have since said that they are not doing energy transactions anymore, simply because they don't think they have the skill in order to identify the attractive ones. In Fund 2, roughly 7 of the deals that represent about 22% of the invested capital were in energy transactions. Without energy deals, that would have bumped up the return on that fund by 0.4 times TVPI. It would be in the teens and IRR, et cetera. So the returns would be much more competitive without that. And we look at that because we want to look at the track record relative to how the fund is being invested today. We want to see the deals that they're doing today. And if they learn from their mistakes, which they did in Fund 2, all the better. That means they made mistakes and then made changes and then made improvements and moved on. And we think that shows in the performance in Funds 3 and 4. So that's the presentation of the manager. I welcome any questions or discussion points we'd like to have.
So this is Christina. I have a question. Can you leave that slide up, please? On Fund 3, when you say it's 91% invested and people came in 2016, so that's already out there, what is that, 7 years? In the market going on 8, and I don't know when it started, and it's 91% invested. How long do funds stay in these type of plans and these type of investments? Do you say I've gotten my 23% over 5 years or whatever the time frame is, and then it's time to exit it? And then if they're illiquid, how do you get out of these? I'm asking these questions for the general education of the trustees. How do we exit this type of investment?
Absolutely. And to be clear, so the Fund 3 is not calling capital anymore. So it is, for intents and purposes, fully invested. The reason why it says 91% is just because the dollars invested relative to the committed capital. I don't want to give the impression that they're still trying to invest that last 9%. That investment period ended in 2020. So that fund is fully invested. They're not calling capital anymore or anything else. They're just they have a fully built out portfolio. So now that that portfolio is fully built out, as those deals come to fruition, and those deals, the life on average is between 3 to 6 years, depending on the type of deal. As you get to that point and those deals get to their full value, the general partners running those transactions will then go to sell, and we'll try to realize that valuation. And then once they go out to sell that company, if it goes through, that cash is then distributed down through the fund's waterfall to investors. So you'll see in the second to right column, a column that says net DPI. That stands for net distributions per invested capital. So it says 1.0x. So what that means is that any investors into Neuberger Berman Strategic Co-Investments Funds 3 have already gotten all the capital that they had sent Neuberger Berman. They've received it back. So if you had committed $100 million and you sent them $100 million, you have gotten $100 million back in distributions. There's still retained value, right? The difference between the net TVPI and the net DPI is 1.2 times. So there's still significant value in the fund that is going to get distributed over time, but they've already gotten that initial cash back. When that gets realized, the fund life is 10 years, right? So the stated fund life of Fund 3 will end in 2026, so 3 years from now. And then generally you'll have some extensions. I believe for Fund 3, it was 2 one-year extensions, possibly 3 one-year extensions. So they have the option to extend that out to 2028, at which point the investors can decide we want to keep extending this fund to gain more value if there's anything left at that point, or we don't and we want to take other measures to try to close it out. So the fund will last probably at least until 2028, just because of the fund life. That's the stated fund term. As far as when you can redeem, you kind of have to wait until the deals are realized, and you can see their DPI, they are being realized over time. Almost half the fund's been realized. But the only other option would be to sell in the secondary market if you wanted to. But that's once again comes at deep discounts and is something we generally don't advise as long as the fund is going along in its regular pace.
So can you repeat that? If I'm looking at the 2.2 times and the 1.0 times, you're saying that half the portfolio's been sold?
Yeah, roughly. So the 2.2 times is total value per invested capital, and the DPI is distributed per invested capital, right? So if to make the number simple, if it's a $100 million fund, 2.2 times means that you're going to have a $220 million in fund total value, right? So the fund has created significant value. And then a DPI of 1.0 means that 100 million of that has already been sent back to you. So really at that point, it's $120 million that are retained within the fund.
And what's the last 4% there?
So the loss ratio, 4%, represents the amount of the number of, the percentage of invested capital that was put into deals that actually came in below cost. So basically deals where the investor lost money as a percentage of invested capital. So on 1.5 billion, roughly 4%, you're looking at about $75 million that was invested into deals that actually lost money. The rest of the capital was invested into deals that had a positive outcome. Now, positive to varying degrees, but positive outcomes.
Okay. I appreciate it.
Definitely, absolutely.
Walter, Jeff, the floor is back to you.
Gwilda, you're on mute.
Our recommendation was for you to purchase into the Newburgh and Berman Fund. I think the amount per the pacing study was $12 million into this fund. I think the final close, I think you told me, Justin, was in December. Am I correct?
Yes, I think they're extending, they're talking about extending, but I believe, yeah, the final close is supposed to be in December.
And how much have they raised? Where are they now? They're probably almost finished.
Yeah, they're upwards of, Elizabeth, do you have the exact number? I think it's upwards of 90% raised.
Okay.
I'd have to look. Yeah, I can get that exact number.
Okay.
They've been in the market for about a year at this point, coming up on a year.
The reason we're Gwilda's asking is because it takes our fund a little bit of time to go through the documents and be able to meet that deadline in December. So if December is a hard deadline, then we may or may not get there based on our turnaround. But our attorney's pretty good at looking at these documents, and so we still, as an investment committee, we still have to go to a committee of a whole to be able to approve. So our investment committee decision only makes a recommendation to the body as a whole. And when's our next meeting, Sue?
Monday.
Oh, Monday. Yeah. Hey, okay. So then on Monday, whatever the recommendation is would have to be ratified on Monday. From today would be ratified on Monday. And then it would take the attorney's ability to be able to get those documents and turn them.
Yeah, and I think that would give us, I mean, if you're looking, would give us about 60 days if end of December is their final close, and typically it can be done within that 60-day period.
A good relationship with Newburgh Berman too, so we can make sure to let them know that they'll be hearing from your lawyers if needed. and they're normally pretty quick to respond.
Thanks. Does any other trustees have any other questions on the presentation? Hearing none, can I get a recommendation as proposed from the consultant from ANCO?
As I stated before, the pacing study,
You've been warned. Beer on Friday. Fridays in August on
Oh,
IS.
somebody's not on mute.
Need to like beer is here. Modelo Water.
Doris, I think that's you.
Elevated taste.
Oh,
so as I stated before, the recommendation was per the pacing study that was done last year, that was presented to the board or the committee, that we invest $12 million in this co-investment fund to help round out the private equity portfolio for St. Louis Public Schools.
Okay, Sue has presented the motion. Does anyone from the, I was gonna say from the floor, but from the Zoom meeting, like to make a motion?
I make a possible motion for the investment committee, October the 19th, 2023, to recommend investing $1 million
Okay.
with
You have to add
NB.
12 in there. You have to add 12.
Okay, I'm only reading what I'm seeing, okay?
Yeah, sorry, I just left that blank because I wasn't sure exactly what the number would be.
No problem. NB Strategies Co-Investment Partners, VLP, as recommended by investment counselor, consultant, ANCO.
Second.
It's been properly moved and second. Is there any discussion? Hearing none, Sue, I'm gonna read the motion again. To recommend investing $12 million with NB Strategic Co-Investment Partners, 5 LP, as recommended by consultant ANCO. Can I get a roll call, please, Sue?
Angela Banks,
Yes.
Christina Bennett,
Yes.
Louis Cross,
Yes. Yes.
Shanice Johnson,
Yes.
Doris Walker.
Yes.
Okay. So we do have 5. The motion carries from this committee. We would need 6 at the board meeting to actually, have the investment approved.
Correct. Thank you, everyone. Gwilda, I return it back to you for anything else on the agenda, or to Sue.
Yep, we do have the flash report. It's not pretty.
Uh-oh, who's presenting today, Gwilda, if it's not pretty?
Well, I will start out. I'll give a little bit of commentary on the market. And then Jeff said he would do the dirty work.
Well, I guess we want to say thank you to Justin and Elizabeth for presenting tonight.
Absolutely. Thank you for having us. It was great. I hope we get to do so again in the near future. So thank you very much.
Thanks, Jeff. The only sad part is that I didn't get to hear Elizabeth on the presentation. Did she get an opportunity and I missed it?
No, just observing, Justin, for this meeting, but thank you guys for having us. This has been great.
And
No
Elizabeth,
problem.
Elizabeth wanted to observe on this meeting, and then maybe going forward, we'll have her participate as well. But she
We'll
wants.
hear her at some point. She's a much better presenter than I am. So
I don't know about that one.
Elizabeth, the only way you're going to learn is by trial and error. And we're pretty flexible on this fund. So we hope to see you on the next round.
I appreciate that. Thank you.
Thank you both.
Thank
Thank
you.
you.
bye-bye.
Okay, well, Sue has brought up the market overview for September. And as you can see here in the month column and the 3-month column, because you'll be getting the full performance report next month for the 3rd quarter. But for the month, as you can see here, Sue, can you make that bigger? I don't know if you can or not.
Sure.
I don't know if they can see that. But as you can see here, that first comment says month, there's negative numbers down the whole page. Both in the equity markets as well as the fixed income markets. If you can see there, small and mid cap for the worst performing areas compared to large cap. And for the month of September, the international EFA fund, EFA actually did better than domestic as represented by the S&P 500. But if you go into the 3-month column, which will be reporting on next month with the quarter, which is more appropriate, you'll see here that still small and mid cap were the areas that were hurt the most, with the Russell mid cap returning for negative 4.7, Russell 2000 representing small cap negative 5.13. And then, but you look there, international for the quarter was actually down more than domestic broad markets at a negative 4.11. If you go down the page to the next section, fixed income, you can see there that fixed income for the month of September was a tough time on a relative basis. Corporate high yield did a little bit better than the rest of them. And on a 3-month basis, corporate high yield was the only place that actually had a positive return of a negative 0.5. You're going to see this, you'll see within your fund, which Jeff is going to take over in a bit, that your managers on a relative basis, for the most part, did protect on the downside, but across the board, it was a down month and a down quarter in the capital markets. Part of that being as you know, the Fed has indicated that interest rates would stay high for longer than what's anticipated. That's reflected in the markets, and rising long-term bond yields didn't help matters any either. As you can see, at the upper right-hand column, from a style standpoint, growth has still, that first section says Russell Indices style returns. As you can see there, the year to date, the actual growth market's actually doing better than the value section of the market, both large, mid, and small cap. And that's a total reversal from 2022, which is the next set of boxes over to the right. Any comments or questions on the general market? If not, I'll turn it over to Jeff to go through the actual fund. Okay, Jeff.
All right, great. Sue, if you want to flip forward to the allocation page, we can just take a quick look there. So again, just sort of a reminder of what was out of what was sort of out of range previously. The only asset class was the hedge funds, and after getting that money back, it's now within the range. So remember, the upside down triangles, those are the system's actual allocations. The vertical lines, those are the targets, and then the tolerable range will be the gray shaded areas. So certainly always like to be as close to the vertical black line as possible, but from a policy standpoint, definitely want to be within those gray ranges. So we're pretty much, we are there on all of the asset classes. So a little bit spot on some relative to others. So you can see the large cap equity right on, small and micro cap not too far above the policy. International, developed, and emerging are both pretty close to being right on, and then the fixed income, some deviations a little bit lower on the core fixed income portion, and then a little bit lower on the multi-sector portion. So real estate still above, and recall that we still have those full redemption in on the UBS portion. So that's gonna take some time to get that back, but as we slowly will hopefully start getting some of that money back over the next couple of quarters, we'll see that real estate start to come in line with that target. But again, still within the tolerable range. Private debt, recall that we did just approve an additional investment there based on pacing, and so we'll start to move that closer towards the allocation. Then the private equity, that's spot on. But again, why do we do these pacing studies? It's to make sure that we don't have these wild swings. And again, understanding, as Justin talked about, that some of these things, we just don't know when we're going to get cash flows, and those can be lumpy. And that's why we always have to keep updating the pacing study, looking for new managers, seeing who's in market, and try and keep us as close as possible. So looking good as far as that policy target on private equity. Private debt will get a little bit closer once we get this the SVP that starts to call in more capital for their investment. So, but certainly we'll be looking for additional managers within that space as according to our pacing. So all good on an allocation standpoint. Any questions? Okay, let's jump forward, and I think what we're seeing here should be no surprise, just based on what Gwilda was just talking about. So I think if you just scroll down everything in the month, and even on the next couple of pages, but let's just stay here. We'll get to it in a second, but you'll find that there was really no place to hide. So this has been a real difficult period for diversification, which is always a challenge for us, because we do talk about diversification and the benefits of it, and trying to be in this asset class when one zigs and the other zags, and having that sort of benefit. And unfortunately, it's just been a tough market that everything has been hit. And again, a lot of it's really had to do with, as Gwilda said, it's the inflation numbers and it's the interest rates. And rising interest rates just does a lot of things bad in a very short term. So it spooks the economy. It causes the markets to run into a lot of volatility. It really is not great for fixed income in the short term. But as we've talked about before, the higher the interest rates go, once they do level off, it sets up a really good base for fixed income. So an asset class that frankly hasn't done too much for us over the past decade, we're expecting as we go forward. And then now that we see the Fed, hopefully start to slow down and go into next year, and possibly even be in a position to start lowering rates, that we see fixed income doing very well and being a strong contributor to the portfolio. So again, that's what we see. And then sort of bring in a lot of the macro things that have been going on in the world, the renewed strife in the Middle East, and that's certainly causing all sorts of issues with oil prices, energy related stocks, and then pretty much anything that's emerging market related right now is just going to react negatively to that type of macro news. So we just having to ride out some of that volatility. But the good news, if we can put a positive spin on anything, is that we're still coming off of a very strong period. So if you're looking at the fiscal year to date period, we're still positive to the tune of 4.4%, and not too far off the policy benchmark. And then the latest 12 months were double digits. So still a very good experience for what we've had over the past 18 months, despite a little bit more weakness recently. But it has started to cut a little bit into those the absolute values of those longer term returns. So if you look prior to the sell-off, where our 5 and 10-year returns were probably a little closer to our return assumptions, those have started to come down. But again, that will ebb and flow with some of these short-term areas of volatility we see in the market. So again, if we were sort of to run a forward-looking asset allocation study today based on the sell-off that we've just seen and what our expectations now are, being very positive for fixed income, the forward-looking numbers are very good for probability of meeting the system's return assumption. So we're pretty confident over that in the mid to the longer term. But again, riding out some of this volatility. Again, on a positive light, I know it's still a negative return, but Lomax, who has had more of that's probably going to be one of your biggest relative underperformance areas for the past 12 months. So still negative in the latest month, but much better than their benchmark. So again, value stocks have been kind of a challenging area of the market with rising interest rates. So think of areas of the value market, in particular large cap value, not too dissimilar in how it's impacted relative to fixed income. So they have very high paying dividends. Anything that pays out a lot of dividends is very short-term sensitive to rising interest rates. So again, when you see fixed income getting hurt the way it has, it's probably going to have a very similar impact on a large cap dividend paying value stock. So, but again, good to see at least for a month them minimizing some of the downside within that area of the market. Sue, if you want to flip forward one page. Okay, so again, from a magnitude of things, when we see the markets being as crazy as they have been, we certainly would expect small cap stocks probably not going to do as well. So when the world is going for safety, they're selling their more perceived risky small cap stocks in favor of either fixed income or large cap areas of the market. Same for international. So you see right below that the developed international negative as well, sort of in lockstep with the small cap stocks. And emerging markets, where, and again, in this type of volatile market, we would expect to be a bit worse than we did, but DFA did a very good job of protecting value on the downside for the month. So you see they're almost flat for the month relative to a market that was down close to 3%. So a nice relative experience, and you can see how what they've been doing is translated into a really nice not only fiscal year to date return of almost 10% relative to a benchmark that's just shy of 2%, and then a 1 year period where they're at 20% for a market that's up just shy of 12%. So really good diversification from that manager within a space that frankly has been really tough over the past 5+ years. Sue, if you want to flip forward one more. Okay, and so the Exponence portfolio you see for the month was negative, but they are ahead of the benchmark for the month, and you can see the sub strategies below. So Foresight was ahead of the benchmark, as was Martin, as well as Argus and Redwood. So all of them, just to varying degrees, doing a bit better than the benchmark. And so you see we're still below the benchmark, but positive for the fiscal year to date period. That magnitude of underperformance for the 12 months, not as wide, but again, we want to start seeing a few more months here of them getting back some of this relative value. But again, a good structure. We did just get a report from them that their the transition to this new custody structure is Sue, is that now complete, or they're still transitioning?
Yeah, I think in October is when they started doing all this transitioning. And so I think it's in process. It'll be interesting to see what it all shows at the end of October, because they're going to be adding some managers. I think we're going to be seeing one of these managers no longer be in the group. So anyway, it will be interesting.
Right. So yeah, so bottom line, again, what they've sort of the proposition they've made to us here is that by changing this structure, creates more efficiencies, lowers some costs, also gives them the ability to diversify further the structure, which they are now have done and will continue to do. So again, we'll look for all of those factors to contribute and bring back some relative value here. Sue, if you want to flip forward one. Okay, so again, here's sort of the challenging area. When you see these tough equity markets, we would hope we could see much better diversification from fixed income. But again, just in the face of the rate environment we've seen, has not really turned out that way. So you see the core fixed income portfolio pretty similar from both of the managers. Manulife down about 2.7, Earnest down 2.4. Opportunistic area, more of a global portfolio, still down, but was ahead of its overall benchmark. So conserving some value there. And again, you can sort of see how that's worked on the fiscal year to date period too. So their market down close to 2%, but they're actually still positive. So nice ability to conserve some value there. And Loomis, a very similar story. So almost flat for the month and well ahead of their benchmark, and then almost 4% positive on the fiscal year period relative to that benchmark being down 2%. So again, a nice way to have some diversification in a market that's had some pretty short-term challenges. So Neuberger Berman, very similar situation, very diverse global type portfolio, and as we've seen, positive on the fiscal year to date period relative to that negative benchmark, and their 1 year period also having a pretty solid nominal return and outpacing the benchmark. And then the emerging markets, again, an area that's been a little tough for fixed income, and Lazard has minimized that to an extent for the month, and bit more challenged for the latest 12 months, and certainly we'll look for that one to kind of get a snapback once we see the interest rates level off and some of this global the economic noise and things in the Middle East and China and other issues that have been really causing a lot of this interim volatility. If we can get a little bit more leveling off, we'll probably see a bigger snapback in emerging markets. Next page, Sue. Okay, and so the global asset allocation managers and hedge funds, again, very similar stories between all of them, diverse portfolios on global areas of the market, really trying to minimize downside. The hedge funds seem to have done quite a bit better job of that relative to PIMCO. PIMCO being more of a liquid strategy within the global equity and fixed income markets. So not totally immune from some of the volatility out there, but still being able to stay positive for the fiscal year to date and in 1 year period, but like to see them a little bit closer to their benchmark as we go through the next couple of quarters. And then the hedge funds as a group, again, with the Entrust piece, it's small, so it's not really moving the needle, and that just whatever valuation is given to that Peruvian bond on an ongoing basis is really going to drive those wacky numbers that we see there. But even if we see something that's for that 1 year period down 90% on 118,000, it's not really it's not moving the overall performance of the system at all. So but as a group, you see where the hedge funds have done very well on a fiscal year to date basis, almost 7% relative to that composite index of just shy of 3%. So again, good diversification from that, good downside protection, and sized very well for being a good contributor for this portfolio. So with that said, all of the rest of it will be the alternative, the illiquid alternatives, where we're probably not going to have very good up-to-date data until we get through the quarterly reporting cycle here.
No, it's okay.
I'll pause there. It was a mouthful. Questions, comments?
Yeah, so I always see the big saying stuff. But the building was like,
I have no comments, Jeff. I was just well, the content to you today this time.
it was like,
Do we have anything else to report other than this?
That was it.
Woo-hoo. All right.
I think, and did we want to talk about the December meeting? And what everybody wanted to do about the December meeting?
I suggested December meeting off unless we have something urgent to discuss. We're not going to have, I mean, it'll be maybe November results, but really, anything else pressing on the agenda, Waldo?
No, actually, and the pacing study will be in January. So that'll be the big thing in the new year. We won't have it in December. We'll have it in January, and that will look at your private side of the portfolio for all of 2024. So all we would have in December would be a flash report unless we brought in a manager or something. And that's something Jeff and I are going to work on as a schedule to start getting managers to come in and review. Once now that we've got a lot of the portfolio work done and got things structured and some of the main documents fixed and the custody search and whatnot, we'll start bringing in managers in 2024.
And the schedule for the December meeting would fall the third Thursday, would be December 21st.
Okay, well, we can't have a meeting because I'm out of town. I'm just joking, but I'm just, I'd say the preference of the committee. If we only have a flash report and we have nothing on the agenda, then I just say we postpone the December meeting. And if everyone else on the call is amenable to that, and we can discuss that as well at Monday's meeting with the rest of the board. Any comments from the committee? Sorry about the peanut gallery back here. Lewis? Doris?
Yes.
Any comments? Any comments?
No, everything went very well. Yeah, and I've just had it my way. Yeah, but I'm not going to Burger King, so.
Alrighty, well, Golda, we'll let you know on Monday, what the body as a whole decides, and you and Jeff. And, if there's no other agenda items, can I get a motion to adjourn?
Before we do that, I would like to thank that young man for that presentation. I never heard anyone speak so long in my life. And he didn't take a breath. So just tell him thank you.
I will relay that to Justin. I will relay that to him.
Boy, I tell you, this can't make this stuff up.
No, you can't.
Oh my goodness. Okay, is there a motion to adjourn?
I make a motion to adjourn.
Second,
I second.
all those in favor, please say aye.
Aye.
Aye. Opposed, motion carries. Thanks everyone for taking the time to be on this extensive and learning, private equity, module today, but I appreciate it. Have a
All
great
right.
weekend.
Okay, everybody. Bye-bye. See you
Have a
on
good
Monday.
weekend, everybody. Take care.
Okay, Jeff. Dwella. Bye-bye.